Let's talk more about this tech run in the broader markets. Joining us now is Lori Calvasina, the head of U.S. equity strategy at RBC. Lori, great to see you.
Great to see you, too.
Your year-end price target for the S&P 500 is 2750. So do you think this tech run that we've been seeing, this really Teflon tech run, you think that's going to break?
Well, look, I think the market as a whole is overextended, and tech is certainly not immune from those issues. One of the things that we've been looking at on NASDAQ specifically is if you look at the CFTC data on U.S. equity futures positioning. What we're seeing there is that a cyclical area like small cap positioning has been very, very low. Investors are still very cautious. But if you look at NASDAQ future positioning among asset managers, it's actually pretty close to historical peak, and it's continued to climb. We saw general positioning get stretched back in February. That's what NASDAQ looks like at the moment. So, to me, I do think there's crowding risk. And if you see that crowding risk unfold in the tech space, it will harm the broader market. That would just be one of several potential contributors to volatility this summer.
When you saw that crowding back in February, was that preceding the record highs? And I ask you this because I'm wondering if you're laying the groundwork to retest those highs before that pullback that you're forecasting for later.
You saw that extreme level, that peak positioning in things like Russell 2000 futures, S&P futures, but you did not see it in the NASDAQ futures. They weren't low, but they weren't at similar peaks the way the S&P 500 futures are. So what this data is telling us is that NASDAQ all along through this has been marching to the beat of its own drummer.
So, Lori, thanks again for being here. So the Russell, you mentioned it briefly, but the IWM, I think, closed below 140. In my opinion, and I might be wrong, I typically am wrong, but in my opinion, the Russell has led us to the upside over the years, has led us to the downside. It clearly didn't get anywhere close to the highs. 135 was the June 11th low, I think. Is the NASDAQ, is the Russell trying to tell us something for the broader market?
I absolutely think you've hit the nail on the head, Guy. I mean, if you look at Russell 2000 relative to S&P, and we also look at it relative to NASDAQ now, it's really the same way NASDAQ is functioning as a defensive vehicle. The Russell 2000 is functioning as a pure cyclical vehicle. And in mid-May, when we really started to see economic surprises pick up, and there were a lot of hopes and dreams on this economy and this sort of second wave being avoided, the reacceleration, the re-engagement, the reopening really taking off, that's when the Russell 2000 briefly took off in terms of relative performance, but it only lasted a week. By the beginning of June, it was gone. And that really coincided when sort of doubts about reopening, concerns about the second wave of the virus reemerged. Investors were willing to play the Russell when those hopes and dreams were running strong. But as soon as those hopes and dreams started to get questioned, the Russell faded again. So it is absolutely a barometer right now.
Lori, it's Karen. Let me ask you something. Do you think that we're going to see some kind of stimulus that will serve to put a floor under the market? And if so, how big? And is that priced in already?
So I think stimulus is largely priced in to a degree. I think kind of getting an extra round out of Washington, I do think that would help markets a little bit in the short term. There have definitely been some jitters on that. But when it comes to the Fed and the stimulus that we've been getting from the Federal Reserve, I do feel like that's gotten generally priced in at this point. I think that's really what put the floor on the market, caused the multiples to expand. I think the problem with all these stimulus ideas is there's only so far they can go. You've really got to see the confirmation in the economic data. And this market is still very short term, trading on these headlines. People are watching the open table and home-based data very, very closely. And if those indicators don't cooperate, if there's a lag between stimulus coming in and those indicators perking up again, you're going to have a problem in the market.
Where do investors hide out? Where should they hide out, Lori, if your forecast for 2750 comes true?
So, I would say on kind of more of the defensive side, we like utilities. We do think tech stole utilities' thunder back during the drawdown. Utilities didn't outperform the way it should have. And now you've got a very cheap sector with very safe dividend yields. If you look at healthcare, that's another one of our overweights. And we really think of it as long-term secular growth. In terms of the secular growth theme versus value, we're actually neutral there on a 12-month view. But within that secular growth bucket, we think healthcare looks more appealingly valued than tech. We're neutral on the tech space. And then just in case we're wrong, we do like to have a cyclical play in our back pocket. And we've gone through, looked at things like financials, the commodities, the consumers, and industrials. And we think industrials is probably your best play if this cyclical rebound, if that data does start to firm up, if we do get animal spirits back in the market. It just looks much more attractively valued to us and, frankly, safer in terms of fundamentals than things like financials or consumer.